Hey, how you going? Rick Neuenhoven here again with another explanation for you. And today we're talking about how buy and hold property investing works. This is a very complicated field and an area. We're only going to be looking at a very simplistic explanation for you and one component, because this is a short snippet, not a detailed explanation. So what we're going to do is we're going to flick to the next slide, which is coming up right now. And what we're talking about here is showing you what the return would be for a property. So the general rule of thumb in the past has been that a property will grow in value or double in value every 10 years. And how do we work that out? We need a rate of return rate of 7% for our property to double every 10 years. So a $400,000 property to be $800,000, we need 7% growth year on year. So you'll see with housing market updates from CoreLogic and RP Data and realestate.com, they'll give us certain centres and Sydney and Melbourne and all the capital cities and say what their capital growth rate is. That's what we're looking at, the capital growth rate, to check the appreciation in the property values in those markets. What we can also then do is actually bury down into suburb specific markets, because Sydney's very big, but then suburb to suburb, you'll be surprised at the differentiating nature of capital growth between them. And sometimes you can be quite unexpected to realise that something that you personally don't like as a suburb actually has a higher growth rate than a suburb that you may like. And I've had this experience before with clients where they've wanted to buy in a particular area, especially because they live in that area, only to realise that that area is not a good as performing suburb compared to other locations which were less preferable for them. So it all comes down to the data. So what we've done in this example here is, with a $400,000 property, we've been quite conservative and actually used 3.5% as our year-on-year growth rate to just show you what can happen with holding a property and allowing for the returns to come. So in this example, 3.5% on a $400,000 property over a 20-year period is still gaining us $395,916 over a 20-year period. Now, if the holding cost to you is zero or negligible, and let's say the holding cost is over a 20-year period even $100,000, you're still making over $295,000 in capital growth. So doing something is the most important thing here, because doing nothing is going to cause us to miss out on opportunities like this to access capital growth. Now, what we want obviously is higher capital growth and a higher rate of return, and so we want to try and use strategic decision making to try and get us access to those locations to get us better returns. But what we're trying to highlight here is, even using conservative natures and conservative figures, that we still can get great returns if we have a long-term strategy.